Every investor chasing the AI gold rush has been told the same story. ARM Holdings, with its ubiquitous chip designs, is the hidden infrastructure play, the shovel seller in a data-driven gold rush. But stories need substance, and on May 8th, that substance cracked. ARM warned that its fiscal Q1 revenue would fall between $1 billion and $1.1 billion, materially below Wall Street's $1.2 billion consensus. The market's verdict was swift and brutal. Shares dropped more than 10% in pre-market trading. The high-flying narrative rooted in AI-fueled euphoria collided with a more sobering reality. The earnings just aren't there yet. This video unpacks how ARM's misstep lays bare a classic pitfall in growth investing, the danger of riding thematic waves without grounding valuations in actual cash flows. It is a lesson in discipline, warning against wishful extrapolation, and a case study of why narrative elasticity can collapse when guidance disappoints. ARM's guidance sent a clear message: not all chips are created equal in this cycle. Management cited a major licensing deal delay and continued weakness in smartphone end markets, long a primary source of royalties. Tariff-related macro uncertainty exacerbated the pain. Citigroup analysts flagged this tension early. While ARM benefits from pricing power and royalty rate inflation, the underlying volume trends, particularly in smartphones, are deteriorating. The context matters. Counterpoint Research had already projected a smartphone volume decline in 2025. As smartphone OEMs battle pricing pressure and inventory destocking, royalty streams weaken. The 10% drop in ARM's stock price was not simply about the headline miss, it was about the fragile scaffolding beneath a rich valuation. In the wake of its IPO, ARM was quickly absorbed into the broader AI narrative. Investors treated it like a hidden gem, a foundational enabler of AI workloads in mobile, edge computing, and increasingly data centers. That narrative lit a fuse under the stock. At one point, ARM shares traded at nearly 59x forward earnings. Compare that to Nvidia at 24.5x and AMD at 21x. This discrepancy didn't go unnoticed. ARM was priced for perfection in an imperfect world. Unlike Nvidia, which has demonstrated robust revenue growth and pricing power in core AI GPUs, ARM is still transitioning. Its AI data center push is nascent. Meanwhile, its legacy royalty base remains tied to smartphones and consumer electronics, sectors currently suffering under macro strain and tariff pressures. The market narrative had overreached. Investors bet on a long-term AI story without giving enough weight to short-term execution risk. Unlike fabless chip makers with direct sales visibility, ARM's business model is built on licensing and royalties, indirect, delayed, and at times lumpy. One large licensing deal slipping out of Q1 can move the needle significantly, as we just saw. This makes ARM's revenue base unusually sensitive to deal timing and end market health. Smartphone volumes impact royalties, and tariff-driven uncertainty affects customer behavior. Even with pricing tailwinds, volumes matter, and those volumes are contracting. Barclays analysts said it best: we remain engaged on the long-term story, but caution that the high consumer exposure leaves the company particularly vulnerable to the macro. It's a polite way of saying great narrative, fragile fundamentals. Why did so many investors and analysts miss this risk? Two reasons stand out. First, the AI narrative created a gravitational pull that overwhelmed fundamental analysis. In an environment where everything vaguely AI adjacent received a premium, ARM looked like a justifiable long. Second, there was a structural blind spot, a lack of appreciation for how concentrated ARM's revenues still are in older, slower growth segments. While the management team spoke enthusiastically about AI opportunities, actual financial contributions remained minimal. There was also the timing fallacy. The market priced ARM as if future data center licensing wins were imminent and reliable. But licensing isn't recurring SaaS revenue. Deals slip. Customers delay, and royalty flows depend on product cycles well beyond ARM's control. What happens when a rich multiple meets an earnings miss? The answer is multiple compression. ARM's steep valuation created a precarious setup. When the $1.2 billion consensus turned into a $1 billion midpoint forecast, the implied earnings drop forced a recalibration. Even modest growth hiccups can create huge downside when the stock is priced as a hyper-growth AI beneficiary. This is the curse of narrative elasticity. It expands expectations rapidly, but collapses when reality fails to stretch in tandem. It's a lesson that transcends ARM. Any investor anchored in long-duration growth names should beware. This episode is more than a one-quarter blip. It's a cautionary tale about how easily narratives can lead us astray. Thematic investing is seductive. It offers clarity in a noisy market, a simplified story that explains why a stock deserves a high multiple. But without earnings visibility and margin momentum, stories unravel. For ARM, the long-term vision may yet materialize, but vision without verification doesn't pay the bills. Investors must learn to distinguish between companies benefiting now from AI and those merely hoping to. In ARM's case, the hope outran the numbers. Here's the hard truth. To invest in narratives, you must analyze what supports them. Who's buying? What are the volumes? How sticky is the revenue? What's the path to margin scale? Simply put, does the story make money? ARM's stumble is not a failure of technology. It's a failure of expectations. The company may well power the next wave of edge computing and AI acceleration, but in this moment, it remains tethered to smartphones, susceptible to deal slippage and vulnerable to macro stress. Narratives can inspire, but they must be cross-examined. Numbers must verify vision. And in the end, earnings discipline always trumps thematic exuberance. For investment analysts, ARM's Q1 miss is a vivid reminder. Even the best stories need proof.